Reinsurance is insurance for insurance companies. In a daily situation, an insurer transfers part of its risk to another company called a reinsurer. The link is that this protects the insurer from losses that are too large or too concentrated. Once that link matters, without reinsurance, one disaster could threaten many policies at once. The basic idea is risk sharing. The clearest example is an insurer collects premiums from customers, then pays part of those premiums to a reinsurer. The explanation starts with in return, the reinsurer agrees to cover certain losses. The consequence is the original customer may never interact with the reinsurer. Catastrophes make reinsurance important. For example, a hurricane, earthquake, flood, or wildfire can produce thousands of claims together. The reason is that normal insurance depends on losses being spread out. That can mean disasters create clusters that can overwhelm one company. Reinsurance helps insurers write more policies. In real life, a company can accept risk it would otherwise avoid. The pressure comes from this. The backup makes capacity larger. The result can be this can support markets where homes, businesses, or health risks are expensive to cover. There are different structures. Think of some reinsurance covers a percentage of every policy, while some applies only after losses exceed a threshold. The process works because the contract decides when the reinsurer pays. Over time, details matter because reinsurance is not one standard product. Quota share spreads every policy. A simple case is this. The insurer and reinsurer divide premiums and losses by agreed percentages. The important driver is that this reduces volatility from the start. That is why it can be useful for a growing insurer that wants stable backing. Excessive loss reinsurance protects against large events. You might see it when the insurer pays losses up to a certain point, then the reinsurer steps in. What matters underneath is that this is common for catastrophe protection. If it is ignored, the arrangement is like a high-level safety net. Reinsurance pricing affects customer premiums. One ordinary version is if reinsurers raise prices after heavy disaster years, insurers may face higher costs. The mechanism is that those costs can eventually reach policyholders. The practical effect is local premiums can rise because global risk capital became more expensive. Reinsurers study risk deeply. Consider they analyze weather, health trends, legal claims, building materials, geography, and past losses. The hidden part is that their models influence what insurers can afford to cover. The outcome is often that risk modeling shapes the availability of insurance. Reinsurance does not remove all risk. The pattern shows up when contracts have limits, exclusions, and conditions. The moving force is that an insurer can still lose money if losses exceed protection or fall outside terms. The risk is that backup coverage is powerful but not unlimited. Policyholders benefit indirectly. In a daily situation, a financially stable insurer is more likely to pay claims after major events. The link is that reinsurance supports that stability. Once that link matters, customers may not see it, but it sits behind the promise. Regulators care about reinsurance. The clearest example is they want insurers to remain solvent and able to pay claims. The explanation starts with reinsurance can strengthen capital position. The consequence is poorly structured reinsurance can create false confidence. Reinsurance markets are global. For example, a storm in one country can influence pricing worldwide if reinsurers absorb major losses. The reason is that risk capital moves across borders. That can mean insurance costs are more connected than many customers realize. Insurers choose retention levels. In real life, retention is the amount the insurer keeps before reinsurance responds. The pressure comes from this. Keeping more risk can save reinsurance cost but increase danger. The result can be the right balance depends on capital strength and risk appetite. Reinsurance supports specialty coverage. Think of unusual business risks, Large construction projects, aviation, and energy exposures often need extra backing. The process works because one insurer may not want to carry the full risk alone. Over time, shared risk makes coverage possible. Claims can involve complex recovery. A simple case is this. The insurer pays its customer according to the policy, then may recover part from the reinsurer. The important driver is that the customer should not have to manage that process. That is why reinsurance operates behind the moments. Bad disaster years tighten the market. You might see it when reinsurers suffer heavy losses. They may reduce capacity or raise prices. What matters underneath is that primary insurers then become more selective. If it is ignored, some customers may see higher premiums or stricter terms. Reinsurance is one reason insurance can handle rare but severe losses. One ordinary version is ordinary premiums alone may not be enough for extreme events. The mechanism is that risk must be layered across stronger balance sheets. The practical effect is the system works by distributing shock. A common misunderstanding is that insurers simply collect premiums and personally carry every large claim alone. In reality, many insurers are part of a wider risk-sharing chain. That chain can affect how much coverage is available, how policies are priced, and how stable an insurer remains after a disaster. Reinsurance does not make losses disappear. It spreads the shock so one company is less likely to collapse under a concentrated event. Reinsurance becomes clearer when it is tested in ordinary life. Take insurer sharing hurricane risk. The point is visible in an insurer sharing hurricane risk. The choice changes because reinsurance changes the pressure around the decision. What matters is the real consequence for the people involved, not just the clean definition of reinsurance. When the example is concrete, reinsurance stops sounding abstract and starts looking like something people deal with in real conversations, bills, deadlines, and relationships. Another useful angle is catastrophe losses spread across reinsurers. Catastrophe losses spread across reinsurers shows how one background condition can change the outcome before anyone calls it a big event. For reinsurance, the hidden force is risk spread beyond the first insurance company. Once that second layer is visible, disaster claims look less like one company carrying the whole storm alone. Reinsurance becomes clear when one large disaster is big enough to test the reserves of many insurers at once. A shallow reading sees only the customer policy and misses the backup arrangements behind it. In the case of small insurer protecting capital, the final result may look simple from the outside, but the pressure was already building before anyone noticed it. Better judgment starts by understanding why insurers protect their own capital from extreme losses. A practical example is global reinsurer pricing disaster exposure. The practical point is not to memorize a slogan about reinsurance. The practical point is to see reinsurance as part of why large-scale claims can be paid at all. That contrast explains why insurers prepare for disasters before the claims arrive. Most confusion around reinsurance comes from missing that hidden exchange and focusing only on the surface event. Reinsurance is insurance for insurers. It helps companies survive losses that would be too large for one balance sheet alone. A final example, claims surge after wildfire, shows why this matters before the outcome becomes expensive, stressful, or emotionally charged. The strongest takeaway is to see the backup layer behind the customer-facing policy. The practical point is to see reinsurance as part of why large-scale claims can be paid at all. Once those parts are visible, reinsurance becomes less mysterious and much easier to handle in daily life.